And I guess it's a massive week. I mean, we've seen the Reserve Bank, they've remained on hold as expected. Interest rates still at a record low, 2.5%. Retail sales numbers coming out today, still not much happening in terms of that front, but of course the election is a big thing happening. So Russell, just in terms of what you expect post-election, is there going to be much of an impact on markets, or how are you positioning your portfolio ahead of this election?
Well, it's pretty clear that the RBA cutting interest rates to record lows is starting to have an effect in the economy. We're seeing the share market up sort of those record highs for the last few years. We're seeing a booming property market in Sydney. Now all this obviously goes into creating what we call the wealth effect. The higher share prices means you've got more capital in your share account. Higher house prices means you've got a little bit more equity to draw down and go and spend. So consumer spending might be a little bit slow at the moment, but we fully expect that to pick up in the coming quarters and the coming semi-annual periods. That, of course, will help the retailers, consumer spending, people buying stuff. So that we're positioning our portfolio as we do in any economic cycle. We focus on high-quality businesses. We focus on businesses that are growing. And irrespective of the economy is doing, if we find businesses that are positioned well, we'll continue to do well.
So are you overweight the cyclicals given what's happening in that space? And
we don't really invest like that. We run fairly concentrated portfolios, and concentrated portfolios of, like I said, high-quality businesses that are growing through any economic cycle and have the fundamentals to back it up, to make acquisitions, taking market share, market leaders, have pricing power and have good volume growth. So yeah, that's how we do it. And
we have Mark on the line from Queensland. Mark, welcome. What's your question tonight for our panel?
Evening, Julia. Thanks for taking the call. Yeah, it's about Coffey International, COF. Bought that around just under 15 cents, and it's been climbing nicely. Just wanted short to medium technical.
Sure. I mean, Coffey International, wow, what a big drop, and then we're starting to come back a little bit. They're involved a little bit in terms of mining services, but they also have a geosciences division. They're in the environmental part. And I guess it's the mining consulting part which has really dragged down the share price over the last 52 weeks. The shares have started to lift back up again. It's been a roller coaster ride, and I guess part of the problem is it's a contracting business. It's pretty hard in this particular area. And I think that they've stopped paying dividends as well. Russell, is it time to go contrarian, or are you still a little bit cautious on this space?
Oh, look, in terms of revenue, the business has been very, very stable. But what I think has happened is the business has gone through a fair bit of restructuring. It's written off a lot of its assets. I'm not sure if that's intangible or if that's fixed assets, but they've forced themselves into a loss last year to basically clear the decks. This looks like a turnaround result this year. Management are buying a bucket load of stock, and they've been buying around the 18 to 20 cents, it looks like. I'm having a quick look here. Cash flow is very strong, 18 million, market cap's only about 60 million, so if you could buy a business for 60 million, it's giving you $18 million in cash flow. I'm not sure if all that's free cash flow, maybe say 10 free cash flow, but even still 60 million, you're getting 10 million free cash flow. That's looking like a pretty good deal to me. Management buying is a very positive sign. So look, the only negative I can see, 650 million revenue last year and probably the year before that as well. So very stable in the revenue, but they've only got 100 million locked in the geoscience revenue now. So it's only 20% of their order book is full. And management's saying that's a similar position that they were in last year, saying that the market is significantly more difficult than it was 2 or 3 years ago. So that 18 million, 10 million cash flow I talked about before, that may halve. So 60 or 70 million might be fair. So look, probably around, like David said, around the 30 cent mark, I'd be looking at these shares being full based on uncertain outlook, I would suggest.
Next call, I've got Vani on the line from Sydney. Vani, welcome. What's your question tonight for our panel?
Oh, thanks very much. Listen, I've been looking for stocks with good growth because the market, I think, at the moment feels expensive. And one I was looking at was Vocus Communications, which seems to be in a very strong market, being a service provider to the internet, fibre and data market. I saw its revenue was up 50% and EBITDA up 36%. So I was just wondering what the panel's thoughts were on Vocus, and especially whether they think how it compares to Amcom Telecommunications.
I think Barney makes a really good point. When the market starts to look expensive in terms of the large caps. We start to look at the medium-sized caps and the small caps, and that's exactly what's been happening throughout the last month. The market's up 1.5%, but the small ordinaries is up more than double that, up by 3.7%. Most of the callers today calling in about the small cap stocks. So looking at Vocus, it is a smaller telecommunications company. It looks at data storage and dark fibre solutions. And Russell, this has been an area that's run pretty hard in 2013. Is this an area that you're positive about?
Oh, we love the telecommunications space. Absolutely love it. The business
Why is that?
Recurring revenue. That's just simple 2 words, recurring revenue. A lot of the businesses that, you have a telephone account, you have a mobile phone account, and when you go into an Optus store or whatever, you sign up on a long-term contract. Exactly the same for these guys. Businesses are long-term contracts. And once they're in, it's quite sticky. It's hard to pick up and well, it's not hard, but it's frustrating to pick up and move. So we like that now. Vocus have a lot of dark fibre. These guys are the ex-Pipe Network guys, and if you remember, Pipe Networks rolled out a lot of fibre, and I think TPG bought them for a pretty handsome sum, and they're sort of trying to do it again through this vehicle. So they've rolled out a lot of fibre in New South Wales and in Sydney, and once all that cable's laid, the capex is largely done, and all they have to do then is connect businesses to the fibre. So the margins are incremental, and you're seeing this in the underlying results. Revenue's up very, very strongly. So capex is largely done. Building up, connecting data centres as well, so add-on services. I get this feeling that this business is, again, using pipe as the example, being built to be taken out.
Okay, and we have Luke on the line from Brisbane. Luke, welcome. What's your question tonight?
Julia. David Hunt appears to have a negative sentiment on the ASX 200. Just looking at the 4 banks, where would be a good buying entry?
So, what are your thoughts? We've seen a little bit more, risk-taking coming into the market, and that's been bad news for some of these defensive areas like the telecom, the banks, things like the healthcare space. Is this a trend that's going to continue throughout 2013, do you think?
I think the healthcare sector, internet sectors, telco sectors, financials have been performing so well because these are the areas of the market that are growing. So in all the reporting seasons, these are the sectors that are continuously growing in, year out. And the big 4 banks have so much power in the Australian market. They control so much in home loans. If you have any wealth management products in your super, any home loan, you're pretty likely to have it with these guys, and you're going to be paying them lots and lots of money. Interesting fact, AFG Home Loans, they have about 10% of the mortgage broking market. They just did a record amount of mortgages.
Wow.
So they're a broker. They act for a large number of financial intermediaries, and I'm assuming that some of the big 4 might be on there, but even if they aren't, it's a very good sign that with property prices rising, people are getting a bit excited and they're taking out more loans. So this might be good for them, and they might get some credit growth in the system, and that's been something that the banks have been lacking for a while. So saying that, I do think they're expensive, and they have been for a while. I don't expect them to fly, and with the market being as expensive as we expect it is, them being 30-40% of the ASX 200, it's just very hard to see any capital growth here. So
Russell, you'd see the banks more as a hold rather than a buy at these levels because they're looking expensive?
Yeah, like I said, you have to use them. Pay them exorbitant amount of fees. If you can't beat them, join them. Record amounts of home loans being done through this mortgage broker, which has 10% of the market. So and markets at record levels. So the wealth management division for these banks are going to be doing very, very well.
So preferring AFG rather than the big 4 banks because they're looking a bit too
AFG
expensive?
is not listed. It's unlisted.
Okay.
It's a mortgage broker.
So would you be buying the banks at these levels?
No.
No. Okay. And we have Mark on the line from Newcastle. Mark, welcome. What's your question tonight? Hi, Mark.
Good evening, panel. My question's on Onthehouse at OTH. It's a smaller stock. It's probably in the online real estate space, more probably geared towards the commercial professional area, such as Residex they use for searches and valuations. Bought in a little while ago, and it seems to be reported well. Signed up the couple of the big banks as customers recently. just thinking, well, I think it's fairly positive and wanted to see if you guys could discuss it and maybe enlighten a little more on it. Thank you.
Sure, a good question coming through from Mark, given that we've been talking about, property running at the moment. What about a company like Onthehouse, Russell? Is it going to be able to benefit from the increased activity that we're seeing in the property market?
It's a great question, Julia, and I don't know a lot about the business, but I know a lot of market participants have been waiting for this deal by a couple of big banks, and obviously this business it specialises in doing property valuations. So a lot of people are attracted to the site to have a look at what the house is worth or what a house they're looking at is worth. So it's a bit of a comparison site. They can say, oh, yeah, the real estate agent is asking this. What does Onthehouse say? I mean, and it can be wildly wrong, but it does attract a lot of eyeballs, and for that reason, they've been trying to do a couple of deals for that data and for media to provide it to two big banks. That deal has been delayed by 6 to 12 months. Hence the shares were under a fair bit of pressure, but they've now announced that deal, coinciding with their result, which was looking a little bit weak without this deal. So, to get comfortable with this business and where it's trading right now, I'd want to have a good look at those deals and what they potentially could mean in terms of additional revenue. But knowing that this is largely a fixed cost business, it's an internet business. A lot of that should drop to the bottom line, so it should be quite value accretive for shareholders.
Okay.